there, everybody. It's Christian Jarvis, head of the Jarvis Wealth Management Group, senior investment advisor here at Canaccord Genuity in Vancouver. I hope that everybody's having a great summer. There's no question that it's been a challenging start to 2022 for the stock markets. I figured now would be a good time to provide a mid-year update and let everybody know that we do believe there is light at the end of the tunnel. Probably going to be a little bit bumpy here over the next quarter or two with perhaps some a little bit more downside. However, we do believe the worst is behind us. And once these markets stabilize and chop sideways a bit longer, we're going to start to trend higher again. So what I'd like to do is just from 35,000 feet looking down, I'm going to flip through a couple of slides, bring everybody up to date, and we'll take it from there. I'm probably going to provide a more detailed video in the coming weeks that will get even a little more granular using a candlestick chart, letting everyone know where we are, where we've been, beginning of the year, where we're at now, and a couple of potential scenarios that could unfold in the second half of the year, both of which should be more positive than what we're experiencing at the moment. So bear with me one moment. I'm just going to look down here and share my screen. And like I said, we'll run through a couple of slides. Alrighty, so here we are. We're going to start again, very top level here using the S&P 500. This is a very broad index in the US. The largest 500 publicly traded companies are represented in this index. Now, I know we're up in Canada. However, whether it be the TSX, the Dow, the NASDAQ, they all follow very similar trends over the long term. I like to use the S&P 500 because it has a lot of data and it does span a large portion of time. So one thing I will point out is this does start all the way back in 1926 to the present, through lots of ups and downs, lots of cycles, lots of recessions. Each of these gray bars do represent recessions. If you'd held this basket of stock from 26 to the present, your return would have been 10.5%. So not a bad return for long-term investors that were willing to ride out the ups and downs. Now, I'm going to get here to this top right-hand side of the chart, this yellow marker here. This is where we currently are. This is a 20% pullback on the S&P 500, which has not been pleasant by any means. Now, NASDAQ being a more tech-heavy index, it's down about 30%. Now, here's the catch. If you drill deeper into these indexes, okay, because they're so broad, they're actually down, their downward movement is spread across, in the S&P's case, over 500 stocks. So the drawdown is a bit more muted. If you drill down into the most popular names in these indexes, the very widely held names, you're going to see a much more dramatic drawdown or correction in price. For example, in this index is Amazon, which has been down as much as 45%, Apple that's been down as much as 35%, Facebook that's been down as much as 50%, Shopify down up to 70%, Canadian banks down as much as 35%. Even in bonds, which has been a safe haven for many years for investors where they look for stability and reliable interest payments, those have been down as much as 30% year to date. So again, the catch is most investor portfolios are down more than the 20% index now, or 20% on the index. If you have a conservative portfolio, a conservative stance portfolio that is weighted with bonds, say even up to 30–40% bonds, your portfolio could be down as much as 10 to 20% year to date. If you have a more growth-oriented portfolio that's more weighted in the infotech names, some of the big cap tech stocks in the US we've talked about, although even with those, there haven't been many places to hide, whether it be REITs, even energy's down 30% over the last few weeks here. Gold is also down. So again, with a more growth-weighted portfolio, it's not uncommon to be down anywhere from 20 to 40% year to date. Again, not a pleasant start to the year, but we've been through this before, and we will get through it. This is the second worst start for the first half of the year, going all the way back to 1970. So again, it's unusual, but it does happen. And eventually we're going to chop sideways, find the bottom here and start to trend higher again. Even just going back here, these are other corrections we've had along the way in more recent history. This one here was COVID. Let's not forget, that was a 40% drop. The markets fell very quickly. 6 to 9 months later, they were back to even. And then from there onwards, they started to trend higher again. The other thing I'm going to point out on this chart is starting in 2008, we have been in what's called a secular bull market. meaning we've been in a continued state of rising stock prices, definitely taking a breather here now with all that's going on in the world, inflation, interest rates, the very unfortunate situation in the Ukraine with the war, supply constraints, so on down the line. It's been a negative mix, definitely putting downward pressure on stocks. However, in a long-term uptrend, and Javid Mirza, our top technical analyst here at Canaccord, he argues that this bull market is going to go out to 2030. So we have at least another 8 years ahead of upward runway for stock prices and investor portfolios. I do agree with his thesis, and despite this unpleasant start to 2022, I do believe there's a lot more upside to come over the next 8 years as we move forward and get through this correction. The other point I will mention too is we do have investors out there that do have exposure to small cap emerging companies. Those have struggled as well big time this year. If you've got the big names like Amazon down 45%, if you have emerging company names in your portfolio, that is going to put even more downward pressure on that piece of your portfolio. So again, right across the board, not an easy start. That said, we do think we're getting closer to the bottom here, and eventually we're going to start trending higher again. So I'm just going to move on to the next chart. How do we know we're getting closer to the bottom? Well, there's a lot of metrics we use. I'm going to focus on this one in particular. This is a measurement of price to earnings ratios without getting into a lot of technical detail. It's just a method that we use to value if stocks are seen as cheap or expensive. Right now, the S&P, again, being a very broad index, it's trading at about 15.5 times earnings. Again, not getting into all the technical details here, but just know that markets tend to bottom in the 13 to 14% range, or I should say 13 to 14 times earnings range, not percent, times earnings. And although this chart does not go all the way back to 1929, I can assure you that if you go back many, many decades, this pattern does repeat itself where markets bottom out in the 13 to 14 times earnings range. And again, being at 15.5 times earnings, that does definitely paint a picture that we are getting closer to the bottom here. So moving on to the next chart, we're going to talk about the big R word here. Is there a recession coming? It is unfortunately looking more and more likely like we may be entering into a recession here in North America. Martin Roberge, one of our top macro economists here at Canaccord, he has moved into the recession camp. Up to a couple of weeks ago, he wasn't quite so sure, but he now is thinking we are going to head into a recession. That said, it should be a mild recession, which is in line with what a number of other economists are saying in North America. Reason it should be mild is because both economies in North America, Canada and the US, have become far less sensitive to energy prices. So even with the spike, they should be less affected by rising energy prices. Also, the capital reserves in our lending institutions and banks are in a much higher position than they were in past recessions. So they're in a much better position here to lend to consumers and businesses in this current cycle. The other counterintuitive point is the labor shortages are more prominent in this cycle, and historically that does lead to shorter and shallower recessions. So those reasons and quite a few others I haven't gotten into are leading Martin and a number of other top analysts around North America thinking that we're going to head into a lighter recession compared to some of the ones we've been through previously. Now, speaking of recessions, this is the last slide I'm going to go through here. This basically illustrates the 12 recessions that we've experienced in North America since World War II. And I guess what I want to point out here is that if you look outwards from the end of the recession, so taking this one that ended in 1949, the recession that happened just after World War II, had you held before the recession and during the recession, you actually would have had a positive return. But to me, the more important numbers here are looking at 1 year, 3 years, 5 years, and 10 years from the end of the recession. In this particular case, 10 years out, you had a 500% return on the S&P 500. Now, on an annualized number, that means the portfolio or that basket of stocks was growing between about 17 and 19% per annum. Now, that is a measure from the extreme trough to the high looking out 10 years. However, remember, if you're a long-term investor, you should be getting around a 10 to 11% return on your equity-based portfolio. But in this particular measurement here, it was much higher than that, again, between 17 and 19%. Bottom line is what this chart is showing is that through all recessions, as unpleasant as it was, had you held long-term over the next 1 year, 3 years, 5 years, and 10 years, your portfolios and investments were looking a heck of a lot better. And quite frankly, the growth is absolutely impressive. Now, the one exception were the 10 years going out after the tech meltdown in the early 2000s. That was a very unique situation indeed, and not a pleasant 3, 5, 10-year period after that. However, over the long term, even if you had held through that before and after that, your returns would have looked much better. That just happened to be a particularly bad 10-year stretch. But again, overall, very impressive numbers. Once the recession comes to an end, you've got a large basket of stocks in your portfolio. You're going to be looking in great shape over the coming years. So again, just jumping back up to this chart here and showing that, again, many recessions over time, they're all part of the normal business cycle, and investing in stocks. Eventually, the economy and the markets do churn through them. They come to an end. The stock markets do find a base and stabilize and start to trend higher again. So I'm going to now stop sharing my screen. And yeah, I just wanted to say, I hope from a very high level that does give people an update. Let them know that as unpleasant as this first half of the year has been, we very much do believe we're getting closer to the bottom here. Next couple of quarters are going to be choppy. There may be a bit more downside, but other than that, we are getting close to the bottom. We want to take a long-term view, be patient. We'll get through this together. I am going to put out a video in the next few weeks here that will get a little more granular and show people more precisely where we are and where we think we are going to be going forward. And the picture is going to get rosier after the next quarter or two. There's no question. So with that, I'm going to sign off. I do want to wish everyone a wonderful summer. I'm around all summer long taking calls and emails. As I like to say, I'm available 24/7. I look very forward to connecting with each and every one of you. Until next time, I'm signing off. Again, wishing everyone a wonderful day. Take care, and we will be in touch very soon. All the best.